Welcome to Investopia Vision. Today we'll share our beginner's guide to the stock market. In this video, we'll take you through everything you need to know to understand and start investing in the stock market. The stock market is essentially a bustling marketplace, its roots tracing back to the Dutch Golden Age, and today it stands as a cornerstone of the global financial system. What you're buying and selling on this market are stocks, publicly traded companies, which are essentially pieces of these companies. You become a shareholder when you purchase a stock, giving you a stake in the company's assets and profits. So let's say you buy shares in a tech powerhouse like Alphabet Inc., Google's parent company, or an innovative car manufacturer like Tesla. You're essentially buying a fraction of these companies and sharing in their profits and losses. If the companies perform well and their stock prices increase, the value of your investment would also increase. Conversely, if the companies were to perform poorly, the value of your investment could decrease. So in essence, when you buy a stock, you buy a piece of a company and become a part owner. Now that you understand what a stock is, let's delve into how stocks are traded and valued. Stocks are traded on exchanges like the New York Stock Exchange and the Nasdaq. This is done through a brokerage account, a financial account opened with a brokerage firm. You deposit money into this account, and the brokerage uses this to execute your buy and sell orders. The price of a stock is determined by supply and demand in the market. Think of it as an auction house. If there are more buyers than sellers, the price goes up. If there are more sellers than buyers, the price goes down. But what influences this supply and demand? Several factors come into play. The performance of the company is crucial. If a company is doing well, its stock is more likely to be in demand. Economic conditions also matter. In a booming economy, stocks are generally in higher demand. Finally, investor sentiment plays a role. If investors believe a stock will do well, demand for that stock increases, driving up the price. But remember, these factors can also drive the price down. If the company performs poorly, if the economy is struggling, or if investors have negative sentiment, demand for the stock may decrease, lowering its price. Remember, the value of a stock is driven by supply and demand, influenced by company performance, economic conditions, and investor sentiment. You might be wondering, why bother with the stock market? Well, investing in stocks offers several compelling advantages. Let's dive into some of them. First and foremost, the stock market has historically delivered attractive long-term returns. Over the years, stocks have outperformed other asset classes like bonds and cash equivalents. This is mainly due to the fact that companies grow over time, and as they do, so does the value of their stock. Take the S&P 500, for example. This index, which represents the performance of 500 large companies listed on the US stock exchanges, has an average annual return of around 10% over the long term. This means that money invested in the stock market has the potential to grow significantly over time. Secondly, investing in stocks allows for portfolio diversification. This means that by investing in a variety of different stocks, you can spread your risk across multiple companies and sectors, reducing the potential impact of a single company's performance on your overall portfolio. Thirdly, stocks can provide income through dividends. These are payments made by companies to their shareholders, typically on a regular basis, out of their profits. Finally, investing in stocks can be a hedge against inflation. Over time, the cost of goods and services tends to rise. However, investments in the stock market can grow at a rate that outpaces inflation, helping to preserve the purchasing power of your money. For instance, if you had bought shares of Google back in 2004 during its initial public offering, IPO, you would have paid around $85 per share. Today, those shares are worth over $2,000 each. This means if you had invested $10,000 in Google in 2004, your investment would now be worth over $235,000, a remarkable return indeed. However, it's important to remember that while stocks can provide significant returns, they also come with risks, and past performance does not guarantee future results. The stock market is inherently volatile, with prices fluctuating daily. This volatility can lead to potential losses, especially if you need to sell your stocks during a market downturn. Moreover, individual stocks can be affected by a multitude of factors, from poor company performance and economic downturns to political instability and global events. A company can underperform, or worse, go bankrupt, leading to significant losses. It's also essential to bear in mind the psychological aspect of investing. The stock market's ups and downs can test an investor's emotions, leading to impulsive decisions that can harm your portfolio. Each investment decision needs to be based on thorough research and a clear understanding of your risk tolerance and financial goals. But with a diversified portfolio and a long-term vision, investing in the stock market can be an easy way to make your money work for you. That wraps up our beginner's guide to the stock market. We hope you found this video informative and empowering. Stay tuned for the next episode, where we'll go into detail about how to invest in the stock market as a beginner. Don't forget to like, share, and subscribe for more content. Until next time.